how do you get more tax credits? So let's say someone was building a project and they got 10 million in tax credits. They sold it off. They got 9 million to build a project. And they said, can we put solar on it? How does that process work?
So sometimes they have some flexibility in the amount of credits that they're allowed to sell. So they're allocated $10 million, but if their project goes up to 10,500,000, it's okay. So when I come in and I say, hey, let's do solar, it's going to cost 500,000, they can add that 500,000 into their tax credit basis. It's what they're allowed to include to sell. So on 4% deals, there's usually pretty flexible and we can add something in. Sometimes there are some states that are running out of credits. They're saying they're coming up against their bond caps and they can't issue more credits. And they get a little more restrictive about the ability to take more credits against an investment later in the deal. But if we put solar in the beginning, they give the credits for that, no problem. They want to support solar. They want to support high performance buildings. They want to support energy efficiency. They give the credits for that, no problem. There's also a federal solar investment tax credit, and it's just for solar. The baseline credit is 30% of whatever the costs are. So 30 cents on a dollar. And if you put the solar into your low income housing tax credit basis, you couldn't also take solar investment tax credits. But now they made a change where you could take it against both your LIHTC basis and the solar investment tax credit. So we usually get 50 cents on a dollar of the cost of solar from the LIHTC basis, and then 30 cents on a dollar from the solar investment tax credit. And the other thing that they did was they added a bonus, the solar investment tax credit, for putting solar on top of affordable housing. So on top of federally regulated affordable housing, which is LIHTC, they give you a bonus of 20% on top of the 30%. So you get solar investment tax credits actually for 50 cents on a dollar, and you get low income housing tax credits for 50 cents on a dollar. This is how tax credits work. Times 4%, times 10, times the tax credit sale value. Sometimes I see they have a state credit and 4%, and you can put the solar against the state credit and the 4% and the solar ITC, and you generate more tax credits than the cost of the solar. So the way the math works out is it's 4% of that cost for 10 years. So it ends up working out to be about 50% of the hard cost. There's a lot of ways to go over.
Okay, welcome to another episode of Affordable Housing and Real Estate Investing. Guys, today I'm pretty excited. I found this guy on LinkedIn, and sometimes you don't think some of the best relationships happen randomly, but I believe in fate. I believe in stumbling across profiles that is meant to bring a lot of value to our lives, including our community and our audience members. And I saw Jared's profile and I checked out his website and I saw that he has a bunch of development experience. And also he helps fill this little thing called the gap funding with a mix of solar. And I just thought, let me try not to be an expert at everything. I always like to be surrounded by people that are smarter than me. So I decided to message him, and it was my lucky day. Jared responded back, and here we are. So Jared, welcome to the show. How are you doing today?
I'm good, man. Thanks for having me. It is a wonderful project when we can use like energy investment and solar to fill a gap. That's the holy grail.
And I just want to set the stage for people, right? Sometimes this thing we call it a gap, right? When you have some debt financing, but then you have to figure out how to get this other source of income or contribution or investment through equity investors. And then there's still sometimes you don't have enough, and it's super stressful for developers. So Jared, let's get into a little bit about your background first and foremost. Like, how did you even get into development first? And then let's get into your business right after. So let's set the stage here. What's been your background in development?
So I have a background in city planning. I was just always interested in city building, housing, and then just have a soft spot for environmental issues. I wasn't really focused in housing originally. I worked for an office developer, and I was really interested in kind of like master plan, like bigger projects. But I realized, one, office building can sometimes be boring. And two, I just really love like the personalized aspect of like housing and how much it means to people. So I just kind of said, like, I'm going to be a multifamily housing developer, rental. Ended up in affordable because I had a bunch of friends that were doing it. And really, it's like the hardest thing in the world to figure out how to put a capital stack together for an affordable housing deal. So
I understand what you're talking about. You got to get really creative.
Yeah.
And I mean, we hear so much jargon in this world, really, honestly. Sometimes we hear project-based vouchers, we hear HAP contracts, we hear LIHTC, which stands for low income housing tax credit. So we've had folks from all sorts, all aspects of the industry come on this podcast to give a little bit of the context. And that gap is always sort of the stressor. It makes people just have a little bit angst because they're a little worried about where's it all going to come from. So you were in affordable housing for a little bit. What was sort of your role in affordable housing development? Were you project managing? Were you raising the capital? Give us a little bit of context.
So I was working in policy, and I was just kind of like had an interest in affordable housing and realized, man, I better learn finance. So went back to school for real estate development. And then when I got out of school, I was just like, I want to build affordable housing. I came out in 2009. It was a bad time, right? got let go from a couple jobs, came back to a job for a little while in policy just to weather it. And then I had a friend at National Housing Trust that was looking for a project manager / director of sustainability and focused on making sure, figuring out ways to reach the green certifications for projects without making it too costly. And what I realized was that developers want to do this stuff. They want their buildings to be sustainable. They want nice countertops. They want them to look market rate, but they just can't figure out how to finance it because their number one thing is when they accept certain sources, they got to keep the rents low, right? And keeping the rents low reduces your revenue, which means you can only support a certain amount of debt. So that's where your gap comes from. So once I started to figure out, that kind of like we're backing into the kind of supportable like permanent loan and how things worked, then I'm super entrepreneurial. So I started to look for ways to sort of boost the operating income. And we do these energy projects to boost the income. We create savings. We go through, we do some upgrades. And yeah, it just really started to like make sense. I mean, when you save a little and it's a long-term 40-year mortgage, something like that, saving a little in NOI means a lot.
And that's really interesting. So you talked about how your job was to find ways to make the building green certified, but then you also were able to generate income. Maybe I want to draw the connection for our audience. When you give examples of how people can generate net operating income from these energy savings of these projects, what do you mean exactly, Jared? Can you give us some examples there?
Yeah. So we would be required from the city, let's say, to do U.S. Green Building Council LEED Silver. And we would go to our contractor and our architect, and we would say, we need to meet these requirements for LEED Silver. And basically, they would come back to us and they would say, okay, we made some design changes and it's going to cost you an extra $500,000. And, in certain places, they started to be incentive programs where you could get funded for that extra $500,000 to do the energy work. And in DC, they have this DC Sustainable Energy Utility. There's some similar kind of like quasi public-private, or the utility has rebates and things like that. What I started to figure out was, instead of this just being like a cost, that because I understood the finance, I could go out and find grants to fill that $500,000, right? And then there was also the savings. And most developers, they're just too afraid to underwrite the savings into their models. Okay. They might have done that $500,000 upgrade because they were required to by the local government, but then there was $30,000 a year in savings that would come from those energy upgrades. And they would just say, whatever, And once we started doing enough of the upgrades, we got good at it to the point where we knew we could rely on the savings. And then we started like underwriting the savings into our loans. We would go back to the lender and we'd say, look, we're going to borrow another $500,000. Okay. There's going to be some grants that are going to come in for 400,000 of it. And we want to underwrite the 30 grand a year more. Our operating income's going up and we want our loan to go up. And we would increase our perm loan by like another $500,000, which is take the 400,000 in grants, take the 500,000 in perm loan. That's $900,000 for an additional project cost. That's 500,000 for these energy upgrades. So there's $400,000 left over now to like pay off your deferred fee, This is what I do now for developers. This is all that I do.
This is really cool. So I want to make sure the audience is following along because I understand what you're saying, but I want to break it down step by step. So when you first started talking about energy savings, right, and you're underwriting this into the income, are you essentially saying, hey, your rent includes electricity, and then that's how it results in income? What is that income made up of? Can you give an example?
So it's typically like Usually it'll be like the common area. I'm used to work in buildings that are sort of mid-rise, 4 or 5 story buildings with a double loaded corridor that's air conditioned, and there's like common lighting, common spaces in a building, things like that. And a lot of the savings that we'll see will be off of that common. And that common is in the pro forma and it's being paid by the owner. Sometimes if we can go into the resident units, we get into some difficult challenges with utility allowances. But sometimes if we lower the utility allowances and we're in a certain area, we can increase the rents in kind to make up that investment. So we do that too.
And just so when you talk about utility allowances, right, just for the folks that are listening, maybe to this podcast for the first time, usually HUD sets aside some sort of things like payment standards. And within those payment standards, usually it also includes utility allowances. So if you don't cover water or you don't cover heating, you have to deduct that utility allowance from your maximum possible rent. But when you have these energy efficiency savings that Jared is referring to, now all of a sudden you might be able to cover a portion of the utilities or maybe even all. Did I catch that correctly? Did I understand you correctly there, Jared?
You're a good teacher. Yes, you understood it. So,
oh, dude, thank you so much. This is how I digest information. I had to say it back out loud to you for me to digest it. Great. Amazing.
Yeah. So let's say that your max rent was $1,000 and you knew the resident utilities were $100. You were only allowed to charge $1,000 for rent and utilities. So you had to do $100 for utility allowance and you could only charge $900 for the rent. If you lower the residents' utilities to $50, you could increase their rent to $950. And sometimes they're confused about it originally, but it's not an increase to them because they were using that utility allowance to pay their bills and they don't have those bills anymore. They have a much smaller utility bill. So you can ask for the rest in rent as a way to pay for energy upgrades, carbon emissions reductions, stuff like that.
I absolutely love that because then now for the audience that is still listening, right, what we're doing is we're taking an extra income and that extra income flows down to essentially net operating income. And then net operating income is used to pay or service a debt is the proper terminology for the entire property. And Jared, for you to quantify these savings, how are you validating these assumptions? Are you getting a third-party engineering study to say, hey, this is based on the materials that you're using here, that's how much energy savings you get? Tell us a little bit more about how do you substantiate this?
So we like to say like we're not engineers. We're sort of like energy solar finance people. So we know that, affordable housing finance is so complicated that engineers can't translate how savings actually works out into any kind of modeling or any kind of investment. So like I realized this being in-house for like several developers that there needs to be some kind of middleman who's explaining like how you repay this investment. So usually if you give me the specifications of the equipment, a lot of times I could guess some things, some different high performance equipment, and I could go out and get that priced with a contractor or whatever. But I need from an engineer the expected savings and the building consumption. So usually I'll partner with an engineer to get that piece. And that piece really comes from like pretty sophisticated energy modeling. And we don't pretend to be engineers. There are a lot of companies out there that do like green certifications and they do energy models and we refer them and we bring them in. We usually get brought in schematics and like early on in the finance process when developers are trying to figure out which points can I go for in a qualified allocation plan. What's it going to cost to go for these points? Stuff like that.
Okay, this is so interesting. I totally relate to you because I'm not an engineer either. And I tell people all the time, I just learn how to analyze the deals. I know how to structure the deals together. But I have no idea how deep the foundation needs to go. No idea. Like it's just, I don't need to know that.
I mean, it's like we just have to find good people that know the technical components.
Exactly. So this is so cool, Jared, because you found this problem and you just through your experience, you saw that there was an unmet need for this problem specifically. And you get to back that with technical expertise between a blend of project management, financing, and how to put the whole deal together in general. So maybe the next question for you is like, are you helping developers in just one market? Is this applicable to every single market in the United States? Tell a little bit about what type of projects might be suitable to engage someone like you.
Yeah. So this works in every market at this stage. It works better in places where the electric prices are higher. There's more interest in it. So that's like California, the Northeast, Hawaii, Puerto Rico. And, we sort of divide the world up between the kind of interventions that we do in a recapitalization or new construction, and then the type of stuff that we can do on operating assets. On a recapitalization or new construction, we really have a lot more flexibility to build in some measures. We used to be constrained, like for instance, with solar, like we used to be constrained to places where we would have to couple like federal incentives with state incentives to make it all pencil out. Now, the federal incentives for putting solar on top of affordable housing, they're so strong that we can get 100% of the capital cost covered in the form of tax credits. Like no problem. It is like I go around the country telling developers that we've gone from like solar being interesting to like a good idea to now like it's bad business if you're not doing solar. It's like on affordable housing, it's like crazy.
That seems like a no-brainer. I mean, I'm assuming that's why your pitch is so easy. And when you talk about solar, right, we talk about solar on top of an apartment building, solar on top of covered parking, solar on a separate parcel next to the apartment building. What are we talking about in terms of like project size and acreage?
We put it everywhere. Rooftop solar is the cheapest. Putting it on the ground is next. And then the more expensive part is the sort of covered parking because you have to pay for the structure. But, what we'll do is we'll start out and see, do we have enough space to take out the entire common area load? Like, can we provide enough power to run this entire common area? And then usually we do. And then sometimes if we have enough space to do more, then we'll try to start eating into like providing resident power. And in certain places where we can provide enough power, right now we're looking at basically flipping from resident paid utilities to owner paid, and then having the owner just invest in solar to power the entire property because they're boosting their rents.
I mean, that makes sense, right? When you own the power and you can cover it, that makes a ton of sense. So are you just focused on installing solar, or do you also consult on other parts, let's say whether or not the panels are insulated, right? Whether or not you're using energy efficient appliances? How detailed do you go beyond solar panels?
Yeah, so we try to stick to the financial analysis piece, right? And look at the specifications that are being provided by the engineer or the architect or sustainability consultant, and then provide some feedback on that. On like a new construction project, we come in at like certain times. We mostly stick to the financial analysis. We'll do some applications for tax credits or applications for grants and focus on really like the sources and then making sure that the sources occur. And then we also do like owner's rep work where we'll follow along with the project as like a development manager, sort of, to make sure that it all gets executed in a way where it performs and you see the savings. One of the biggest issues that I run into is that how do we make what's on paper be reality? Right? There's risk here in that like we do this energy saving thing and it doesn't perform. And we're afraid to underwrite it because it doesn't perform. Those groups that are like really interested in trying this, sometimes they'll ask us to like follow along with their whole project and like come to construction meetings and check in on all of the different energy components and make sure that the building actually gets to the end and performs.
And when you talk about performing and not performing, are we talking about measuring the generation of the solar panels, or how do you measure performance, I guess?
I've always been taught as a developer that unless it comes out on the trailing balance it didn't perform. I don't care about like specific consumption savings or whatever. If you can't do enough to figure out how to actually save dollars, then it doesn't matter. So when I say that it performs, we're making sure that it actually is producing the power that's expected and doing the math to show that the savings like occurred.
Got it. And is that math or the proof of what you're measuring for generation, for output, does that have to go back to some sort of audit agency, like to the government, to qualify you for the tax credits? Like, what does that process look like?
It's a good question. There are some versions of this where if you apply there's a low income bonus adder on the solar tax credit, and they do have some sort of compliance requirements around that. They don't really ask you to report, but I think in case you get audited, you do need to have kind of a track record of it. So we create some like agreements and things that you can use to make sure that you're in your audit trail, like you're doing what you need to do.
I love that. So you've been such a great tease on this part, Jared. So is it fair to say for someone to engage you, or the best timing to engage you and your team is in the beginning? Maybe they just locked up a piece of land on an option contract. They're talking to architects and engineers. Then is that the best time to bring you in? Like, where and when should people bring you into the deal?
Yeah. I mean, we get brought in anytime from, like, I would say earlier the better, right? Because we can start to plan, we can work alongside the architect to explain to them all the different incentives that they should be designing to. For instance, like, we're working with a developer that also does manufactured housing, like manufactured affordable housing. And they're like, hey, help us design our manufactured housing to achieve like every incentive, every energy incentive that there is. So when we're early in, we can really design to all the incentives, right? Honestly, like early in my career, I think it was wonderful to learn all the certifications and everything like that. But you don't need the certifications to do the energy projects in a way to save money. And sometimes they could be a little distracting because there's like additional things in there.
Wow. Okay.
It's a good, like, sort of guide path. It's a good way to get yourself right and get your organization right and like make your development process work. But the outcome, what we're really trying to get at is the energy savings piece. And you don't have to do the certification to get to the energy savings piece.
So well said. That's so good to know. Because sometimes people, when they think about energy efficiency, they only think of either solar, or they're like, hey, I got to get green certified or LEED certified or whatever, right? That makes perfect sense.
No, and I work with a lot of really savvy developers. They're sort of like, they've done the math and they're just like, I don't have to do the certification anywhere, but I'm doing most of the work anyway toward the certification. It's like, it makes economic sense. So, if, like, for instance, if you have a project where you're going along, you're doing really well, and you have lots of contingencies, sometimes people will bring us in and they'll be like, help us do solar before we finish here. We do that, and we do that all the time. And it used to be like they were trying to use contingency. Now we show them how to fund it all out of tax credits, and they're like, you didn't help me use the rest of my contingency.
And you're like, we did better. What are you talking about?
Yeah. I was like, pay down your developer fee, your deferred, any deferred developer fee, man. Like, don't complain to me. Go find something else to use your contingency on.
You're like, I just found this pot of gold for you. You're welcome.
So some of them, so a lot of new developers, they like with solar, like when they're new to solar, they say to me, they're like, what if it doesn't perform? I'm like, well, we just paid for all of it with tax credits. So you put no equity into this. So if it doesn't perform, does it really matter? If you want, I will work with you and I will make sure it performs. It's a good bet. But let's say you do this and then you stop picking up the phone anymore and you just kind of go on your own and you let the system turn off. We got it covered.
Oh, okay. So if someone, let's say they're about to finish up a new construction, right? They haven't gotten their certificate of occupancy yet, blah, blah, blah. But they were like, okay, we want to do solar. When they come in and talk to you about how do we add solar in this last piece, what does that process look like? Are you saying, hey, let me look at your acreage, let me see your plans, and might be what you'll be able to fit on it?
We look at their plans, we look at their model, we do like a layout on their roof or, the ground or a carport. And then we talk to a couple installers in the area, figure out what it would cost. We tell them, look, okay, here's how much it would cost. Here's how much tax credits, solar tax credits you can generate. Here's how to do the math. If it's a 4% deal, do you have some flexibility if you generate more tax credits? Are you up against a cap? Or if you generate more credits, are you going to be able to put it against your basis? Usually on a 4% deal, it's fine. On a 9% deal, everybody's always maxed out. The 4% deals are just like a slam dunk. Then you go back to your tax investor and you say, hey, will you buy my solar tax credits?
And Jared, let me pause you a little bit. Let's actually take us a little bit of time to explain tax credits, because sometimes we say tax credits and people don't know it's federal income taxes or it's property tax savings. But in this scenario, I think you're talking about low income housing tax credits. Great. And how do we get that money back? We keep saying we get it all back in tax credits. Can you just walk through high level? How does that process work?
Sure, yeah. So if you're a housing developer, you apply to the state for an allocation of tax credits, and then you go out and you sell those tax credits. And let's say you have $10 million in tax credits that you'd like to fund your project. And then you go out and you sell that to a buyer that has a tax bill and is trying to figure out how to get tax savings from instead of paying their full tax bill, they're looking for some sort of tax savings on their tax expense. and they might pay you, let's say, 90 cents on a dollar for that $10 million. So they might pay you $9 million in cash for $10 million in tax savings. Is that clear enough?
Yes, absolutely. We've had a few people come on and explain it, but for those people that didn't know about it, I want to make sure they understood it. And maybe to kind of wrap up that piece, it's like somebody asks me all the time, like, why would someone do that? Well, you just made $1 million, right? You pay $9 million for a $10 million return. It might come at a later date, but sometimes people might be unaware of the Community Reinvestment Act, right? Sometimes these banks, they have to reinvest back into the community.
Yeah.
And when they buy these tax credits, that qualifies or that is counted as part of their reinvestment back in the community. So not only are they doing good, making return on their money, but they're also fulfilling their obligation for that community reinvestment. So
yeah,
I just want people to understand.
I think what surprises people a lot, just average people, when you talk about tax credits too, is that there is an organization or somebody that has so much tax liability, like so much of a tax bill that they owe, that it's an opportunity for them to save money by buying another source or finding another way to pay their taxes. So it's sort of a shocking thing. I think the first time I wrapped my head around it, I was like, wow, I was like, this is how they talk about how some big corporations have zero tax bill. And you're like, how does that ever happen? It's things like this.
And that makes perfect sense. So I want to round out the new construction conversation with maybe just a quick example, right? So let's say someone was building a project and they got 10 million in tax credits. They sold it off. They got 9 million to build a project, right? That's what they did. But they came to Jared and they said, Jared, can we put solar on it? How do you get more tax credits? Do you reapply for more tax credits? Because they've already been issued this 10 million in tax credits. How does that process work? And how do you support that developer in that process?
Sure. So sometimes they've agreed with the state that if certain costs go up in their project, that they have some flexibility in the amount of credits that they're allowed to sell. And so they're allocated $10 million, but if their project goes up to 10,500,000, it's okay. So when I come in and I say, hey, let's do solar, it's going to cost 500,000, they can add that 500,000 into their tax credit basis. It's what they're allowed to include to sell. Does that make sense?
It does. Is there when they get issued those tax credits, right? Are you looking for a certain clause where they say like, hey, there's a contingency if their cost does go up? Or like, what are you looking for in their agreement with the state?
Yeah, they usually, they know pretty quick. So 9% deals, like I said, everyone is already always over. They have too much eligible basis and they can't count it. So on 4% deals, there's usually pretty flexible and we can add something in. Sometimes there are some states that are running out of credits. They're saying they're coming up against their bond caps and they can't issue more credits. And they get a little more restrictive about the ability to take more credits against like an investment later in the deal. But if we put solar in the beginning, they give the credits for that, no problem. They want to support solar. They want to support high performance buildings. They want to support energy efficiency. They give the credits for that, no problem. So, we used to have an issue where there's also a federal solar investment tax credit, and it's just for solar. And what it is the baseline credit is 30 cents on a dollar, 30% of whatever the costs are. So 30 cents on a dollar. And we used to have this issue that if you put the solar into your LIHTC basis, into your low-income housing tax credit basis, you couldn't also take solar investment tax credits. But now they made a change where you can take credits. You could take it against both your LIHTC basis and the solar investment tax credit. So we usually get 50 cents on a dollar of the cost of solar from the LIHTC basis, and then 30 cents on a dollar from the solar investment tax credit. And the other thing that they did was they added a bonus, the solar investment tax credit, for putting solar on top of affordable housing. So on top of federally regulated affordable housing, which is LIHTC, which is low-income housing tax credits. So they give you a bonus of 20% on top of the 30%. So you get solar investment tax credits actually for 50 cents on a dollar, and you get low-income housing tax credits for 50 cents on a dollar.
Wait, wouldn't the low-income housing tax credit get sold at 90 cents on a dollar, like 80 and 90 cents on a dollar?
Yeah, you're right. So you do get a slight discount. Sometimes it just depends on where you are. Sometimes I see, 87 cents. Sometimes I see in Georgia, they have a state credit and 4%. And you can put the solar against the state credit and the 4% and the solar ITC, and you generate more tax credits than the cost of the solar.
Ooh, okay. So you could almost get paid for putting in solar essentially on top of the net operating income savings. So if you, let's say you spent 500 grand on solar, can you get 500 grand in 4% tax credits to pay for that? So if you get 9 cents a dollar, you get essentially 450 grand, right? For that.
So the way the math works out is it's 4% of that cost for 10 years. So it ends up working to be about like 50% of the hard cost.
Thank you for clarifying.
I can do the math. 50%. It's like the solar cost. This is how tax credits work. Times 4%, times 10, times the tax credit sale value.
That's gonna be a great clip to kind of share that with people. But now I get it. When you get to 50% of the cost of the sale of the tax credits, roughly, then you get 30% from the federal income tax, the solar and investment tax credit. Then you get another 20% for the additional bonus for affordable housing. So now essentially it's almost 100% free. But if you have state tax credits, that's where it kind of brings you over.
Yeah, the state, there's a lot of ways to go over. So I have like kind of like a list of things that like there's some things I say you got to take this, but keep this in your back pocket. Like there are some nonprofit developers that they're very worried about insurance costs, and they're so happy with the opportunity to increase their NOI, and they don't want any more loan. And they're just like, I'll take $30,000 cushion, like in operating, because expenses are going up so much these days. I'm really worried about that. We could really use an extra 30 grand a year. So then they don't try to like increase their loan size, and they leave that there. Like I said, there's also other grants out there, like other state grants. Environmental Protection Agency just let out $7 billion for the solar program. They made 60 awardees. Almost every state and several tribes received an award. Many of the awards are like $250 million, and it's for solar on top of low income housing and for low income people. That's it. So I'm not even counting those grants right now in what I was just describing with there are ways where, there are deals that I look at where I can generate $1 million, additional sources, no problem. We've been rolling around the country and just kind of like whatever developer wants to listen. We're like, let us show you how financing solar and energy works and see if we can get you guys comfortable underwriting it.
And then you basically say, we pay for ourselves when we come to the deal. So
yes, in fact, so there's an application process for the bonus. So I'm a developer. I don't really like to consult, frankly. So like I structure a lot of stuff where we'll say, if you get the bonus, we'll take a share of it. Like you don't have to pay us. It's only pay for performance. And then the other thing that we like to do is we like to do solar financings, like solar development projects across like 10 properties at one time. And what we'll do is either the developer can own it, or we can bring in an investor or something to own it. And we'll put solar across a bunch of different properties and then finance it all in one shot. And we can charge a development fee for it's a little development project. Might be $10 million deal, and you're allowed to charge up to 20% developer fee in solar.
20% developer fee. That's a very healthy developer fee.
Yeah.
On top.
So, if you could support it.
Right. So we kind of covered a new construction piece. That made a lot of sense. Is there a big difference when you're doing, let's say, an existing project? Let's say you have 400 units and you're getting ready to do a big rehab and we want to bring you in. Does it have to be a LIHTC deal in that scenario to bring you in? Or like,
no.
What would the process be different, so to speak, compared to a new construction project?
What I have found doing this for many years is that in order to play with any sort of debt, any additional debt, that you really need to be in a full recapitalization or new construction where you're building the capital stack. Because, and I've done this many times, the tax investor and the lender, and sometimes multiple soft lenders, local governments are involved in these deals. And if you have some idea of trying to do a loan for $500,000 or $1 million to do some energy upgrades on an existing property, you just get beaten down. You get tortured. It's really hard to get approval to add anything into that capital stack. And there's actually a lot of strange incentives where the interested parties literally don't want you to touch the operating of the project. They want you to operate it responsibly, do a good job with what you have, but don't bring any additional cash or anything into the deal. Because the way that the tax investors have structured the project is they're also making money on losses and depreciation. And when you start to bring cash into the project, it reduces losses and depreciation.
Okay. Well, that makes sense, especially if there are tax investors in that deal.
So the way we finance solar is actually separate from the project itself. And we sign an agreement with the project to sell it. We will not trifle with. So what I will do is if there are some really, really great incentives around, I will try to couple them with like reserves on the property and get access and use some of the reserves, because that's already cash that's in the deal, and then couple it with some incentives. And you can get away with that because you're not asking for approval for like an additional loan. And sometimes I have done before where if it's a private owner and they have a pretty strong interest in the deal, an equity interest in the deal, it's rare. It's usually not the way affordable housing structuring works, but they could invest more equity for a stronger NOI. Sometimes that happens, but it's
interesting.
Like I said, it's pretty rare.
Because I'm trying to think about like other properties, like let's say like our foundation's going through a rehab on 450 units right now. We own it entirely. It's not a tax credit deal. We're exploring using tax exempt bonds to finance the rehab and a renovation of 450 units. Maybe about 25% will be on a project-based voucher, but it's not 100% affordable project. Like how would someone engage you on something like that? Would you come in and just sort of come in, put in the solar and be the financier and the installer on that type of deal?
With that one, with you guys having that much control, I'm a housing developer first, and it's not in the interest of the property if the property can own the solar, like if it's possible for the property to own the solar. So what I would do, I would only consult because it's the right thing to do to show you guys how to invest in it yourselves, because it's worth more. And if you pushed back and you were like, we don't want to do this, but we want to do solar, then I would find somebody, or I would have an investor that I worked with or something like that come in and buy it. But most of the time, what I find is that in those sort of power purchase agreements or energy service agreements, if you're not doing multiples at the same time, the savings from one of them is relatively small and doesn't really attract the attention of the developer. You kind of need to do like 10 of them, 15 of them to make it worthwhile.
And but when you say 10 or 15, like 10 or 15 multifamily properties, or interesting. That's pretty large. That's a pretty large sum. Okay, got it.
Yeah, but with your 450 unit property, you probably have an incredible opportunity to save. You guys, first, if you just looked at your common areas, and then if you wanted to get more aggressive, we have some developers that are literally looking for land next to their properties to put solar and just becoming like self-sustaining. It's incredible time that we're in.
Yeah, I'm so grateful that you came onto the podcast today, man. I've learned a ton from you today. I've always thought about there is some expert out there on this piece of energy, on this piece of solar. And I'm so glad I found you today, man. I'm so glad we had this conversation and you brought tremendous amount of value to the audience. So for people that wanted to work with you and they want to have a consultation or at least some kind of discovery with you, where can they find out more about you, man?
Yeah. So www.housingsustainability.com.
All right. Everybody, I hope you follow him. I hope you follow Jared on LinkedIn as well. I really, really enjoyed our conversation. Jared, thank you so much for what you do, man.
Yeah, thanks, man. I appreciate it. Keep in touch. I want to hear how that deal goes. If you're doing a bond deal, you should be like really looking at how you can leverage every piece of energy in that thing.
I'm going to talk to you right after this podcast is over. All right, everybody. Make sure you follow Jared on LinkedIn. Check out his website. And Jared, I hope I get to bring you back in a few months or a year from now and we talk about a real deal that we did together, because I'm excited. I'm sold. I want to figure out how to work with you, and let's see where things take us, man.
Awesome, man. Have a great weekend. Take care.
All right. And we are out.